All right. Good morning, good afternoon to everyone, wherever you are. You're welcome to the Africa Real Estate Market Outlook webinar organized by API Events. Um, it's great to have the opportunity to moderate this session. You're welcome to the Africa uh, Real Estate Market Outlook for 2022. I guess most of us potentially have attended one Outlook event or the other for our respective countries or regions, but it's always great to get a sense of what's going on from a continental perspective. Obviously, this offers some form of diversification and comparative benefits, and I guess this is a very great conversation to have. The panel is a panel consisting of players that play across the African market, so they can definitely do justice to the conversation that we want to have today. What seemed like the second year anniversary, of a pandemic, we were just awakened, to even more gory details of potential invasion, in that can cause great impact across the world. Speaking of the Russian invasion into Ukraine, and these potentially have impacts, across real estate markets and various economies globally. And these are some things that we'll be talking about today. On the panel, we have Bronwyn Knight, who's CEO of Grit Mauritius. We have Ni Adeleye, Head of Real Estate Finance, Africa Regions at Standard Bank, Ilaria Benucci, Head of Construction and Real Estate at the CDC Group, UK. And of course, we also have Thomas Riley, who is Managing Director, Lango Real Estate. I'd just like to invite all the panelists to come up on screen now as we get into the conversation. Okay, welcome everyone.
Thank you.
Thank you.
Yeah, brilliant, brilliant.
Thanks, Tayo.
Yeah. So I guess I will just start off the conversation with you, Nii. And obviously, you focus on real estate from a financing and investment perspective, and it will be just interesting to get your thoughts on the continent. What are the key trends that we currently see on the continent? In terms of real estate markets, what sectors, asset types are kind of interest? What are the trends that we currently see?
Thanks, Tayo, and thanks for the invite, and thanks to my fellow panelists. I think from our perspective, from a Standard Bank perspective, what we see and or what we've seen is that the real estate market has been more resilient than was anticipated at the onset of the pandemic, and I think that's a positive one for all participants. What we've seen is on the retail side, trading has for assets that were stabilized and established prior to the pandemic, you'd seen stabilization rates return to normalcy, and in some cases, actually, a buildup of trading capacity with some level of flight to quality, sort of driving that. We're seeing a return to office. So, and even though this year thus far, I mean, I've been able to travel to about 3 or so countries, which was completely impossible a year or two ago. And what you're seeing is increased sort of letting activity, increased sort of inquiry activity in offices, You've seen sort of implementation of COVID sort of principles or COVID social distancing sort of realities in offices, and what that has translated to is sort of a neutral, a net zero effect in terms of office demand, office space demand. In some cases, you've actually seen, because of that sort of implementation of COVID realities, increase in demand for office space. So you are seeing that trend, which sort of speaks to traditional asset classes, and that's been somewhat sort of positive and comforting. Industrial continues to sort of chug along with leasing sort of picking up across sort of industrial assets in many of the jurisdictions. What we are also seeing is new activities, or should I say, increasing sort of development activities in some of the newer market segments. So in the alternative classes, you're seeing sort of growth of data center sort of investment activities. You're seeing sort of a drive for student accommodation across the markets because there's a structural and fundamental gap there. Affordable residential is also sort of picking up steam in terms of interest. And some of these realities may be driven by the effects of the pandemic. You're also seeing sort of, new investments into sort of owner-occupied office premises, which also sort of sounds counterintuitive to some of the concerns with office space during the pandemic as well. Key markets in terms of where you're seeing investor activity, the usual suspects, Kenya, Uganda, Ghana, Cote d'Ivoire, and still quite a lot of activity despite the dollar liquidity realities in markets like Nigeria and Mozambique. You're still seeing some investor activity in those markets as well. So that potentially sort of summarizes what we've seen, or what we're seeing in the markets. You're expecting to see sort of a greater sort of flow of capital this year, certainly more than 2020 and 2021, into the different subsectors. Definitely.
Yeah, brilliant. Thanks so much. And we'll continue the conversation on capital flows, especially from your perspective of debt or debt capital and what kind of assets and locations that capital will be flowing into. But I think I'll just kind of ask similar questions, but move across now to someone that actually holds a portfolio. So I'll move to Bronwyn. What trends do you see in your portfolio, and even across the competition? What kind of trends are you currently seeing?
Thanks, Teo. So obviously we've had the COVID period, which has been quite dramatic to the real estate sector. And we've just released our half-year results, and I dramatically said that half of our property portfolio was effectively boarded up over the COVID period. Grit had and has 25% of the portfolio exposed into hospitality and 25% into retail. So it's been quite interesting to see the buoyancy in the market around those two particular subsectors. So we've seen quite a dramatic recovery in hospitality, specifically around our type of hospitality that we invest in. Very strong counterparty, triple net lease space. And we've obviously seen recovery in tourism, recoveries under the markets under COVID. So that's had a direct correlation to hospitality per se. The retail segment has actually bounced back a lot quicker than we would have, we actually thought. We've already seen sort of 10% upside on rentals coming through, on rental recoveries. So really around our existing portfolio, it was really around seeing what was going to happen around the recovery around those specific asset classes. Now, from a further sort of growth perspective, and where does our capital go next, and what have we done? So under our development partner, which is the Gateway team, we have deployed capital, significant amounts of capital into data centers. We've completed one of the first data centers for Liquid Telecoms in Nigeria. We've completed American Embassy residential compounds. We completed the compound in Ethiopia. We're just busy handing over the compound in Kenya as we speak. So we've seen mass resilience in those infrastructure type assets. And what I mean by infrastructure type assets that really are resilient to a lot of the macros that we've seen out of COVID and will continue to see into the market. So that are really supplying infrastructure needs for international global corporates. The industrial side per se, and I think Nii alluded to it now, we're seeing quite a large capital allocation coming into the business for industrial assets. We have probably got around about $200 million worth of pipeline of light industrial spread across sort of East Africa and West Africa region, which I've spent the last couple of months securing. And we've seen quite a bit of inflow of capital. Grit was successful last year, closing a round of just over $100 million worth of fresh capital, both for an industrial side of the business and obviously fresh capital into the business. And we're really seeing that capital being interested in more infrastructure, sort of resilient assets for Africa. So whilst we've had a very interesting time, and as I said at the beginning, dramatically say we boarded up half the portfolio over COVID, it's been really good to see that recovering. And furthermore, this capital flow going to assets, as I've mentioned, these data center type assets. The other asset class is healthcare. We are about 3/4 of the way completed 2 healthcare projects in Mauritius for an international operator out of India. There'll be the first 2 oncology specialist units for that sort of East region. So not only are we excited about the real estate, but we're actually excited about what we bring into the market. Traditionally, people traveled abroad for that type of specialist healthcare. So what we bring into the region is really, really fantastic. And actually, we delivered and have delivered those projects under the COVID period. So our development team has done a phenomenal job actually over COVID. So we're quite excited to see what's next. And obviously working very closely with both sort of all forms of capital. Actually, we've seen some interesting capital and types of different versions of capital looking for Africa real estate exposure. So we're quite excited for what's to come.
Brilliant. Thanks so much for those thoughts, Bronwyn. And I mean, I just want to ask, why do you think that's been a counterintuitive bounce back in hospitality?
So it's interesting because, I mean, we saw a dramatic bounce back pre-Omicron. And then who would have thought what we saw happen over December? So effectively, we invested in Beachcomber, Lux and Club Med. And we saw obviously a dramatic shift over that period. But what we've seen in occupancy rates, our hotels currently sit at over 85% occupancy in those regions. Club Med in Senegal's just come off 85%. They're going into the close part of their season. I think there's just a dramatic push for tourism and people to travel again. And they're going into these type of regions, which is really good. So, Beachcomber and Lux were telling me that their booking rate is higher than it was 3 years ago, what they're seeing in the up and coming season coming now. So again, these groups have to recover. These groups wrote off a significant amount of money over COVID, as you can imagine. Thankfully, all 3 groups were recipients of very large government support funding. But it's good to see actually people willing to travel, wanting to travel, and these occupancy rates going back up. So, we quite, the groups that have been resilient and the groups that have been really lowly geared going into the COVID period are coming out the strongest. And we're actually seeing the take up being quite aggressive over those particular hospitality groups.
Yeah, I guess sometimes we just can't use past performance to predict the future, can we? From our desk, we just looked at what happened with Ebola and how it decimated hospitality. And, we just made those sort of bland predictions. But here we are, hospitality thriving. Okay, thanks, Bronwyn. I'm going to move to Ilaria and again, just ask you, what are the trends, from an investor perspective, what trends are you currently seeing?
Good afternoon, everybody. I think that I will be commenting something similar to what has been just said, as in I think that the key trends are obviously return to the office and traveling, and therefore hotels are back into the radar investors, especially when you have, I mean, some hotels, not the high-end tourist one that Brownie was talking about, but more business hotels. There's quite a lot of distress on the market, and so I'm sure that there's been some activity over there. The other thing is that we've seen similar trends, of course, because we operate on the same market, but certainly what you can call business infrastructure assets, and so data center, lots of interest in that, logistics, and again, hotels, business hotels, say about 4-star. What's interesting for us as well is what we call social infrastructure, and that is housing, affordable housing, and student housing. Some movements there as well. Unfortunately, I mean, what we have seen is more student housing developing quite well and attracting capital, but in South Africa, not in other countries, or in other countries a very high-end level where we are not obviously interested in investing because of our impact mandate. The one point where, I mean, I think that Brian and I always disagree is about liquidity on the market, and I think that that's still a bit of an issue. So there hasn't been much activity that we have seen in terms of selling and buying completed assets. Obviously, there's been some in the hotel space. There's been a bit in data center, but that's more or less what that's it basically. And I think that a couple of people looking at fundraising that some concern. What I've seen more happening is this mobilization of local pension fund money, for example, in Nigeria, because I mean, obviously that is something that people have been working and trying for quite some time. So hopefully there will be some success there, because that could be really something that change a bit the dynamics of the market. So I would definitely back something like that. I mean, it would be something interesting for me. Yeah, I think these are the key things. In terms of specific office retail, I think is very much related to the specific market where they operate. But certainly, again, more of business infrastructure asset. And again, I call it social infrastructure because of where I'm coming from, basically. But these are the key trends that we see.
Awesome. And I couldn't agree more with you, especially from a perspective of affordable residential. Mobilization of pension funds money would definitely come in very handy. Thomas, I'm so sorry. All these people have said so many things, and now I'm moving on to you. But I mean, from a Lango perspective, what kind of trends are you seeing? If you could just add to the conversation on that.
Yeah, thanks, Tayo. Look, I think I'm going to basically concur with what everyone said. You know, as Ilaria said, we're all in the same market, and I think we've seen similar trends unfold. Just a few things to maybe highlight from my side. I think, you know, the earlier comment that Nee made around the robustness of the market has been absolutely something that's played out in terms of our portfolio. I think if we look at our performance throughout COVID, I think we were a bit concerned about the work from home, you know, sort of the way that played out in Europe, as an example. I'm based in London, and you know, that certainly was a very strong theme here. That did not play out to the same extent in, you know, the markets that we're invested in. So our office assets in Ghana, Nigeria, and so on, you know, have been really quite robust, and more so than that, we've seen good lease up. So it's almost a counterintuitive situation where one would have, you know, expected that leasing would have been difficult, but we've closed some significant leasing during the period, and you know, moreover, we've seen, you know, as far as rental collections are concerned as well, the performance of our business throughout this period has been extremely strong. So, you know, compared to the rest of the developed world, you know, certainly a stronger performance in terms of both leasing and financially from a collections perspective. So very encouraging in that perspective. I think if I look at the retail assets, you know, once again, not nearly as hit as the rest of the world has been in Europe. I mean, clearly we saw a downturn in both footfall, you know, a downturn in turnover, and so on, and certain assets closed for a short period of time, but lockdowns were not really that prevalent, you know, throughout the region. So On average, performance has been, was fine. I think we've seen a strong turnaround, though, in terms of those statistics. Again, in line with what Nee said earlier. So we're pretty much back to pre-pandemic levels across the board. There are, some things that we're dealing with. I think, if we look at the unrest action as an example in South Africa and the way that played out, there's no doubt that some of the South African anchors have had their eyes on more domestic matters as opposed to, looking to grow their presence offshore. And in fact, we've seen, certain of the main grocers indicate, that they're looking to concentrate their operations in certain countries and divest out of others. So that has been something that we're watching quite closely. And I think, the fact of the matter is that, from an African perspective, historically, a lot of the anchor tenants in particular and some of the larger line shops have been South African. And I think, we've been putting a lot of effort into making sure that we see much more of an international flavor coming into the assets, that we see more European, etc. brands, come into the space. I think other than that, from a trend perspective, we've also been approached on the data center side of things. We're busy with some interesting potential transactions in that regard. Healthcare has also been a theme that's come through quite strongly. In fact, even one of our offices, we've had a large healthcare outfit come through in terms of putting in a clinic at one of the assets, and so on. So I think healthcare very strong. Data centers is definitely something to watch out for. That's definitely a growth market as far as we're concerned across the continent. But to Ilaria's point earlier as well, I think if one looks at the number of transactions that have actually happened across the continent, there hasn't been much. I think the reality is that there remains a shortage of quality capital across the space. There's no shortage, as far as we're concerned, of opportunity. So it's much more a shortage of capital. So we're getting quite close to a point now where we are about to have a step change in terms of our capital position, and hopefully that will speak to clearly an increase in transactions. In terms of where that's likely to flow, I think we're looking quite strongly at remaining focused on the office and retail sectors. I think industrial also looks attractive, but at the end of the day as well, opportunities in that space, I think we'll largely have to develop. We're seeing one or two opportunities as that we could potentially unfold, but pricing is also got to be watched quite carefully. So
okay.
That's hopefully a good overview.
Great. Thanks so much, Thomas. And I guess I'll just start the second round of questions with you, and obviously just get kind of like shorter responses from each panelist. And I guess it's on what Ilaria raised earlier in terms of liquidity, and just considering the global turmoil, and interest rate hikes. From your perspective as a deployer of capital, how do you see all this impacting, you being able to raise capital for new projects going into 2022?
So we've actually seen quite a lot of interest from a capital perspective. I think we've been quite fortunate in growing essentially our platform and developing it to a point where we are, we're able to accommodate quite a bit more capital. And interestingly, the interest has been global. So we've seen a fair amount of interest coming out of Asia of late. We're busy with the process in the Middle East as we speak, and then sources of capital on the African continent actually that we're busy with right now. So we're in the midst of a fundraising period right now as we speak, and I think we are pretty excited about. We're nearing the end of that process, and it's looking very good. So very encouraging.
Okay.
So liquidity on the equity side, good. I think on the debt side, we've got no issues on that front. I mean, Nee is one of our key bankers. We closed out what was the largest restructure or debt transaction in the property finance markets last year. It was a $300 million finance transaction that was closed. that's and I think the terms of that were very good. So liquidity generally on the equity and the debt side, as far as we're concerned, is certainly looking up.
Brilliant, brilliant. And I'm just going to ask Bronwyn as well, but in a different. I'm just going to ask it a little differently. Do you think the interest rate hikes and investors essentially seeking for higher yields, thereby making Africa a more attractive market, and you being able to raise more capital in this kind of times? Do you think that's the case?
Yeah, so I think one of the interesting propositions of Grit, and obviously sort of why we founded the business as is. So we've got the development arm, so we're able to control all of our development pipeline. So effectively, when Thomas and Eliara mentioned about liquidity, we're not naturally a buyer of completed assets. So one, there's a lot of development type opportunity, and if you've got a platform to develop, especially around the industrial side, there's quite a bit of opportunity that comes out from that perspective. But the interesting proposition around Grit itself is that it's a high dividend yielding business, and effectively listing on a premium segment in London, it attracts a really aggressive dividend yield. And I think the interesting, and I've just come off roadshow in the UK, I've spent a week there last week, and it's interesting to see that people are looking for dividend, and they are looking for yield, and they can't find it in ordinarily developed markets. I mean, I think it was that pre-COVID, obviously exacerbated by COVID. And it is interesting because growth and dividend isn't coming out of markets. And obviously you've got the issues that are happening in Europe at the moment. So we are seeing a very big interest. I mean, around about 40% of our investor base are income funds out of the UK who are seeking dividend yields. And sort of benchmark to what they're currently getting, around 4%. Anything better than that is something that they would really, really consider. So one of our largest investors who backed our capital raise at the back end of last year was a big income house out of the UK. And furthermore, I mean, around half of our share register are African pension funds who are also seeking dividends. So I think if you're able to have a platform that allows investors to access different types of mandated returns, so if you have the ability for them to obtain dividend, NAV growth, development yields, and you're able to put a spectrum of offering, because whatever people might say, complex capital is complex for Africa. It's not easy at all. And even running this business over the last 8 years, I can tell you that we've raised X amounts of capital, and it sounds like a huge amount of money, but it's been that difficult. So whatever anybody tells you, it's not easy to raise capital for Africa. So you have to be flexible in your mandates, and you have to be flexible in the types of capital. So we've introduced DFI money for the first time last year. IFC came and backed a large industrial player of ours in East Africa. We're doing a lot more with the DFIs, but the DFIs don't want to invest in listed equities, premium listed company, because it's not seen as development enough. But they know that they want to align with a business like Grit. So how do they do it? They come into substructure. They come into our development type assets. And that's what we've been able to construct over the last couple of years, is that we've got different points of entry for capital to enter our business. We took on a preference note from a private equity type players at around $30 million at the back end of last year as well. Also different types of capital. So unless you are inventive, unless you're progressive, unless you are realizing that there are these restrictions on mandates, you have to be flexible to bring money in at different levels of the business. And that's what I think we have got really right. So it's one, that's about the real estate, but how do you actually fund this real estate and the growth going forward? And the DFI money is, and I'm not just saying this because Eliara is on the call, is so important for Africa. And you have to be flexible for their money to be able to come in. And that is a big learning, and you have to spend the time. I mean, I think we went through about 8 months of IFC due diligence, as we do with our pension funds. So I'm very much used to it. So you have to be flexible to realize that this is the platform, but it's not easy to raise money for Africa. And whether it's debt, whether it's equity, as much as it's great to get money from Lee, he doesn't make your life easy. It is multi-banked. You have to have different parts of capital. We invest in 14 African countries outside of South Africa. We've got 7 asset classes. You have to go across many spectrums and that's what we've had to do. So it has been an interesting journey and will continue to be so.
Brilliant, brilliant. I think I'll just go straight to Nii now. Nii, are you more expensive? Are you more accessible? What's what the turmoil, all that's happening, is it making you freeze funding projects, or are you even cheaper?
Definitely not cheaper. I think I mean the landscape is still sort of evolving, but what is observable is the uptick in pricing, and I guess you have to look at that from two different perspectives, or in two different paradigms. So a lot of the funding that happens for real estate in the continent, at least across East and West Africa, is largely sort of cross-border, largely sort of dollar-denominated funding. In that market space, in line with what's sort of happening at the global level, you're seeing an uptick in pricing from that space. However, I think on a realistic basis, the impact with many of the African platforms would be largely neutral, in my view, in my opinion, for a number of reasons. Obviously, the impact of increased pricing is a reduced debt capacity if revenues remain flat. However, for many of the operators, their attitude or appetite, should I say attitude to debt, has been largely conservative for most operators. So you shouldn't see that uptick flowing through massively in terms of the impact on them. But I would let Tom and Bronwyn speak to that, and Ilaria for some of the investee companies as well. So when you think about that, you will see an uptick. And then the other reality is, it's a function of what proportion of your capital, of your debt capital that comes up for refinancing in this period. If not much, your average weighted cost of debt would largely be, would not be materially impacted, except if you're doing sort of a massive capital raise within this sort of time frame. Also, if you've been hedged in the first place, then you should see the benefit of that also flowing through. On the local currency side, I mean, in the markets that we play in, you haven't seen a significant impact of that of the global activities on pricing. I mean, but then not a lot of the deals are funded in local currency. So we, at the moment, overall, I don't think you expect significant sort of impact on the operators in terms of the uptick. The kind of uptick that is being recorded is probably about sort of 50 bips increase in what would have been the historical sort of benchmarks just about a month ago. Depending on how the events sort of translate, that might go up or might come down or stabilize, but the jury's out on that. So let me stop at that for now.
Yeah, thanks so much, Nii. Thanks so much. And in terms of pricing, I think that's very, very fair. I wouldn't say you're super expensive. All right, Ilaria, it would be great to hear your thoughts on pricing and appetite to invest in projects as well. But I also want you to talk on ESG and how big a factor that has become, for organizations like yours, and should we be expecting ESG funds focused on real estate and construction, in 2022 or near future?
Sure. Pricing, debt is too expensive, so a simple one. But let's see. I mean, is that the kind of leverage that you see in real estate outside Africa, you don't have it in Africa, and it is not just because people tend to be more sort of careful, but it's because of the cost of debt, which is quite high, sometimes higher than even equity. So I don't see much changing right now, actually, with what's happening right now. in the world. I think that probably interests are going to go up, and we shall see. Also with inflation coming. So moving on ESG, yes, I think that on that front we are very, very excited. As you probably know, we do not invest in buildings which are not green, or when we develop buildings, we develop to EDGE standards, which is a sort of world knowledge IFC classification. And now we are trying to push, I mean, we're already doing this in India. We are pushing where we buy into existing portfolio, our money normally go for further development. We insist in trying to retrofit assets. And it would be great if we can do something like that in Africa as well. And I think that people are getting more and more sensitive, positively, tenants and investors to that. I really think that nobody would want to be in what we can call a stranded asset, so brown asset, but green asset. I think that in terms also of valuation, future valuation is inevitable that green asset would achieve better valuation. And at the moment, it's not so much that you can say that they would command lower cap rates right now. What they do is that if I'm a tenant and I have to decide between two buildings, I will go to the green one. But over time, I suppose that's what we're going to see. And also, to Brownie's point about, yes, fundraising is always extremely challenging in Africa, but more and more climate risk is more and more a consideration for investors, and therefore I think that would be also an aspect, a relevant aspect in this particular field, and also look at publication. I mean, it's not specific on Africa, but that's the trend. You have JLL publishing, talking about green buildings. You have McKinsey recently publishing this actually I have in front of me, which is called Climate Risk and Opportunity for Real Estate. So it's becoming more and more common in the narrative. I remember years ago, for me, it was a bit of a struggle to persuade developers and investors that it actually makes sense. It was part of the mission. Now it's not anymore. Everybody talks about it, and I think it would be a very key element in valuing asset going forward, and for investors deciding where to invest their money. So yes, positive on that front, very positive.
Brilliant, awesome. All right, Thomas, just going to ask you your thoughts on office in particular, and retail. Obviously, we've spoken about it, but office in Africa, you know, in 2022. How do you think? What kind of forecast do you think? And a lot of people have spoken about newer subsectors, data centers, student accommodation. Do you still think these are the assets to focus on in 2022?
Oh, look, I think we're quite optimistic as far as office is concerned generally, and I think that's backed by a few things. I mean, the one is that you know, we've seen a strong level of demand coming through from an occupier perspective. We acquired certain assets a couple of years ago which had historic vacancies on those, and there's been enormous traction, you know, on filling those through the pandemic, and not just filling them with anyone that comes along. I mean, we've had very strategic, very high quality blue chip international tenants that have filled that space, and that trend is continuing. So we're actually, as I mentioned, counterintuitively earlier. I mean, it has been counterintuitive to an extent. I mean, one would have expected, you know, this whole work from home rhetoric to spill over a bit more into Africa, but it hasn't, you know. So our markets have been very strong on the office front. And, you know, but I think as far as the other asset classes are concerned, or other sectors, if one looks at data centers, we're excited about that. You know, we're seeing some level of return on the hospitality side of things, not hotels. I mean, we're not invested in that like Bronwyn is, but you know, if one looks at more sort of the restaurant space and so on in our shopping centers, etc., that is coming back on stream. They've had a very tough time, but you know, I think we're optimistic about how that's going to play out. But I think as far as new capital coming into the market, I mean, we remain committed to our focus, which is prime office in the key nodes. So we're not going to look at anything in the secondary markets, and I think that strategy is played out in terms of demand. and the robustness of those assets. So that has worked well. But I think, to the extent that we can get, key users from a data center perspective and logistics for that matter, which are more on sort of long-term triple net lease basis, then, we'll pursue those opportunities as well. And we are pursuing opportunities in that sense right now. So, but I think from a market perspective, I think Kenya is something that we're looking at quite strongly now as well. I think we've seen a huge lease up in that market as well. So I think regionally, there's been some slowdown in certain markets over time, but that seems to have evened out. Generally, I think a sense of optimism.
Brilliant. Bronwyn, do you agree with Thomas? And in addition to that, can you speak to investment strategies? Would you be tweaking your investment strategies, and what kind of strategies should we be expecting to see a lot of players adopting in 2022?
Thanks, Teo. So I think from our side, sort of what we are adapting, I mean, we've been quite vocal around the fact that we don't want any retail exposure going forward. Well, any new retail exposure, should I say. So we won't be investing in any retail going forward at all. We actually currently in the market disposing of our Moroccan asset, and that is currently under offer, actually, and that constitutes about 10% of our asset base in relation to retail specifically. So we have got no interest in progressing retail for various reasons. I think we've seen a lot more resilience, and because we actually are tenant-led, so our strategy is slightly different. We follow the likes of American Embassy. So we've got a lot of corporate accommodation. We service the American Embassy across Mozambique, Kenya, Ethiopia. We're closing 3 new projects with American Embassy at the moment. So corporate accommodation, that infrastructure type asset class, is a very big sort of play for our teams. So retail, as I've mentioned, we're not focusing on it all. Infrastructure, when I classify infrastructure, it is the corporate accommodation, light industrial, cold storage, warehousing. As I mentioned at the beginning, we've got about $200 million worth of industrial warehousing, cold storage, which we have 2 of the DFIs currently backing us on that particular transaction. So that will be a very big focus on for part of our business. We've got 2 healthcare projects under construction, which is really exciting. So we're not just talking about it, we've actually got them under construction. The data centers, we completed that very large data center for Liquid Telecoms in Nigeria in a period of around 9 months from start to finish. It's a great story in relation to how real estate can actually support these data center operators and actually how it is physically done. That particular case study is great to see, and we've got a number of other opportunities now coming out of that. So our focus is tenant-led. Around 15 tenants make up almost 90% of our revenue stream. So the idea is that we will continue to do that. So wherever these particular tenants want to go, our strategy is to follow them into those regions, hence why we are so multi-geographic outside of South Africa. Between those 2 businesses, we're in 14 African countries, North, West, East, and SADC. So that's where we're seeing a lot of the focus. And actually, interesting enough, that's where our capital is following us too. So we're seeing a lot of capital very interested in that infrastructure play, and in different types of capital, which is also really exciting to see. So that is really going to be a focal point of our particular business going forward.
Brilliant. Sounds good. Tenant-led, following the demand, not building it and saying they'll come, building what they want. Sounds good. All right, Nii, what will you be financing in 2022? And I think I want you to answer this in a quite a structured manner in terms of what kind of assets and what countries, and perhaps if you can even double down into what kind of cities are exciting. Are you currently looking for projects? I want to finance stuff in this city or country because the dynamics, or the numbers just look strong.
Thanks. So I'll say, in addition to the CDC invested companies, Lango, Grit, those remain key focus clients, I guess. For us, you are looking. I mean,
So,
you're
Neil,
looking
are you also telling us you're following your clients?
Definitely.
Okay.
Definitely. You follow the money. Definitely. If you start from the subsector perspective, or should I say the real estate sector perspective, I mean, there would be a strong focus on industrial, on office assets where where underpinned by sound sort of credit quality type tenants. You would look at your sort of stabilized and stabilizing sort of retail assets. Obviously, in selected countries, depending on where they are in the trajectory of stability. A key component is what I already mentioned in terms of the quality of your counterpart. So because that is very relevant in terms of the asset management, asset stabilization, and sort of the portfolio management realities that you face in terms of what it takes to sort of manage these assets. Obviously, in terms of new activity, you're seeing quite a strong play on the industrial side. And we continue to, I mean, from a lender's perspective, that continues to be very appealing and interesting. The data center pieces of opportunity also remain quite strategic. In selected markets, student accommodation, I mean, we've seen platforms in East Africa. We're seeing platforms emerge in West Africa for student accommodation, and there's there's a developmental element to it. There is the sort of DFI sort of underpin and support for those asset classes as well, and that plays to us from the ESG perspective as well. So for us, you think about the ESG, about sort of the environmental bit, that also continues to drive appetite in terms of where we fund. But you also have the social and the governance aspect of it as well, that becomes something that we measure, and it's become something that is quite critical from a Standard Bank perspective. We've talked about alternatives in terms of education and business infrastructure with data centers. Those elements become sort of the subsectors that will sort of direct our focus this year in selected markets as well. Middle income, affordable housing, not social housing, affordable housing, middle income housing also would remain a focus for us, where sort of the macro factors support end user finance proliferation, and where sort of the domestic environment sort of encourage the creation of that asset. If you talk about countries, I sort of alluded to it earlier, the usual suspects. So Kenya, Uganda, we're seeing some interest building up in Tanzania. So you kind of you take a look at that. When you move to the south and central markets, obviously the SADC countries remain sort of areas of focus. But you look at Zambia, there's a positive trajectory with the new president. You're gonna have to wait and see what the IFC sort of loan workout scenarios translate to, and what stability creates in the economic environment. Mozambique is still sort of tracking what the realities in that market is. Some of the upheavals from last year, you're gonna have to see how that works out to attract new sort of investment and capital. Then if you go to the Western African markets, you're still seeing some interest in Ghana, though there was a bit of a sort of downgrade that happened recently with that, and there's some currency volatility sort of pressures coming through there. But it still remains an attractive market. Cote d'Ivoire is emerging. Senegal is also emerging. And then ultimately you have to sort of take a look at Nigeria. It's perhaps a little too large to ignore, even though the dollar liquidity realities continue to put pressure on the investability of deals in that market. So you have to be very selective about the clients you back, the opportunities you look at, and how you kind of structure that to support clients through the cycle, because some of these realities are cyclical from that perspective. If you drill down to cities, I mean, it will be the key cities: Nairobi, Lusaka, Accra, Lagos, Abidjan, and the like, which will continue to sort of Kampala, which will continue to attract attention. So I think that should give you a sense of the thinking from our side, at least.
Absolutely. Thank you so much, Nee, for answering it in the short manner that I requested.
I'll stop there for now.
Thanks so much. Interesting, you touched on affordable housing and obviously making a distinction between affordable and social housing. And that's always a distinction that is important for developers or whoever to understand, even end users. But a few questions are already coming in. And just before I move to Ilaria, I would just like you to answer on one on affordable housing. And I think it's from Robert Hornsby. And he says, we found that the lack of buyer financing, and I think that's essentially mortgages, on sustainable local terms is the key constraints to affordable housing delivery in West Africa. And I would indeed say Africa, or at least this person thinks West Africa. Anyone seeing interesting and scalable blended finance solutions to this problem? I'm sure Ilaria might be able to touch on that, but from your perspective, what do you think?
There is no easy solution to that problem. The end user financing piece is actually the greatest one to resolve. You look at a country like Kenya, and I think by the last statistic, the total number of mortgages in that market is probably below 70,000 in a country population of over sort of 40 million thereabout, over 40-50 million. Similarly, when you look at Nigeria, I think the numbers are below 150. So finding a solution to that it becomes critical. The backside of that equation is that when with some research that was done with IFC and some of the sort of multilaterals, was that you actually look at the effective tenor of leases that of mortgages in those markets are below 7 years, which means that there's a high level of social commitment to home ownership. So it's really around being selective about the developer and their depth of capital, of liquidity that they have and capital support, and being able to structure that along the line with selected sort of tenancy base, occupier or ownership base, rather, where you can use those sort of projects as a template to demonstrate the strength of the market and the depth of the market, and then finding and then leveraging on that to slowly scale up. But it's not likely that you'll be able to do that on a wholesale basis at this point. You have to remain extremely selective. The macro factors is what sort of dictates that, and to the extent that you can get those macro factors stable and get even local currency lending at about 12% or 12% and below, you will see a massive explosion in the opportunities in that segment of the market. I'll let Ilaria maybe speak more to what from a CDC perspective.
I completely agree with you, as in the real issue is not so much about supplying the right product, is on the demand side. There's no mortgages, and therefore it's very difficult to unlock the market. One of the big problems then developers in affordable housing have is exactly the velocity of the sales, because they're very, very slow, and therefore it takes 10 years to sell 500 units because there is no demand. And so I think that's a big issue. There is more interest. There are more people that are looking into this. I mean, I would say that the difference between social and affordable is that affordable is commercially viable, which is what we focus as well ourselves. So what we're looking at right now is backing, where possible, rentals. So rental platforms. You know that International Housing Solution, which is a South African company, is now raising a fund, has raised a fund in Kenya, and the unlocking on the market then stands on to the point that they can go to developers and say, okay, we offtake, you basically forward purchase 300 units, say, and that would help obviously liquidity on the market, and then these units are going to be rented, and therefore you start creating a positive circle and sustainable. So this is the kind of initiative we're trying to look into, because frankly, to invent the mortgage industry in Africa is a bit of a challenge right now. It depends country by country, of course. Some countries have better structure, other less, but that's the big issue. And therefore our investment in South Africa in diversity, which is a downtown Johannesburg urban redeveloper, is anchored again by rental platforms, and that's very key.
Interesting. And Ilaria, a question has just come through for you, quite related, and I think it's off the back of something you mentioned. Adetola Oyebade just asked, can Ilaria shed more light on how and maybe why debt may be more expensive than equity in African real estate finance? I don't know, perhaps you mentioned that at some point.
Well, first of all, it depends what's your cost of equity, okay? Because if you expect to have 20% return, which in frankly in our currency are a pie in the sky right now, because again, don't consider when you invest equity, as we all, I mean, we all do here. I mean, you are by definition exposed to local currency devaluation. You can have your rents probably brownie. You can say, of course, with the American embassy and whatever, your rents are linked to her currency. But often is a question also having investment that devalues every year as the currency does. And therefore, to recoup that money in hard currency is very complicated. And the reason why it's more expensive is, it's just because the interest rates are very high. Because there's nothing specific for nothing. It's not real estate. Is debt financing is very expensive. Because I mean, you look at something which is 9-10% in foreign currency, let alone in local currency. I think is macro factor, is not specific on the sector, I would say. And then again, is a question of what your expectation, because if you can look at equity returns, which are at the same level of debt returns, realistically, why would you do equity? So it's not easy. I mean, it's the challenge that we all face every day.
Absolutely. Thank you so much. And I guess I have time to ask Thomas and Bronwyn a similar question, and that has to do with currency risk. Obviously, from your revenue side, you potentially can hedge that, getting your rents or or sales values in dollarized. But how do you hedge? And Bronwyn, perhaps you can speak to how Gateway does this. How do you hedge, on the development side of things?
Yeah, so I mean, I think currency per se in Africa is quite complex. So I think, as Ilaria said, at grit level, we've been, relatively successful. 95% of our revenues are actually collected in hard currency, and we're dealing with tenants that operate in hard currency. In some instances, we're not even collecting rentals in country; they're paying us out of country. But there is, and one of the aspects of disinvesting out of retail is that I think there's always going to be an impact of local currency on retail, especially when it comes to buying power and all sorts of other things. But the local currency impact on the development side has been an interesting one. We built the American embassy in Ethiopia. Again, I can't wait one day to have case studies of all of these projects. And my goodness me, I mean, I think between the political unrest and of what happened on the local currency basis is that there was a lot of risk around, obviously, just cost of construction ultimately coming through. So whilst the American embassy pays this great US dollar rental, you obviously are subject to this construction risk in local currency. So you have to become quite sophisticated, I say, in putting in products and that to secure that currency hedge, especially over the construction phase. We actually, interesting enough, in Ethiopia, borrowed in local currency, which was actually not what we ordinarily do. But we actually matched that to obviously what we were doing on the construction side. And because we were collecting in dollars, it actually made sense to borrow in local currency. The banks were fairly aggressive at the time. we have been lucky to move money out of Ethiopia even over this period, but it has not been for the faint-hearted. I think it's caused us many a sleepless night. So specifically, absolutely, I think that currency risk is it's obviously a material consideration. I mean, I met with my team yesterday. Our currency risk sits now currently with the euro and the dollar. We report in dollars, and we actually have all of our hospitality tenants sitting in euros. What's happening in Europe at the moment, an impact on the euro. It's actually, we've got about 30% of our revenue streams that are collected in euros. So back to our reporting currency. So we actually don't just navigate the world of local currency challenges, construction risk around those local currency, but we've now got euro dollar issues at the moment too. So never an easy time per se, but it's trying to remove the complexity. So I think one of our biggest things is that, and our mottos for this year is we want to try and create simplicity. I think people get anxious, and investment in Africa, people get anxious. So as a management team, you have to try and create simplicity to external capital coming in. So again, you have to look still, you might all be treading water underneath, but you have to sort of say, okay, we understand the risk, we've mitigated the risk, we've put insurance products into this thing. But again, you need to try and navigate and mitigate a lot of those challenges, and currency is one of them. And try and create simplicity. I keep on saying at the end of the day, we're real estate players, we're international, we let to global tenants, we collect rentals. Yes, we're in Africa. Yes, we're in 14 African countries, but let's just put that aside. Let's create simplicity. And obviously currency is a major component of that.
Brilliant. Simplicity. Thomas, how are you navigating those murky waters?
Yeah, I think, to Bronwyn's point on simplicity, that's exactly the mantra that we followed since we established this business, a number of years ago. And essentially, if we look at our business overall, we have 97% of our income in dollar. Clearly, we have a retail component, but in terms of the weighting of our line shops, which are clearly all, mostly in local currency or linked to dollars, it's very small in terms of, from a revenue perspective in the overall scale of our business. So we've been quite fortunate in the fact that most of our assets are located in the key capital cities mostly. The result of that has been that the bulk of our tenants are international and they pay in dollars. So, we're not looking to break that investment thesis for that simple reason, that the minute, as far as we're concerned, we don't want to land up in a situation where we run the risk of having an asset in an outlying area, which, it's always good to have a tenant that one can follow, but ultimately, leases don't last forever, and we'd be nervous about the currency component and the complexities that brings. I think the biggest issue that we have found, though, over the last 2 years or so has been Nigeria. I think the liquidity and lack thereof, and actually externalizing funds from that market has been very difficult. We've managed to put some solutions in place, but they by no means eradicate the problem. So, we're hoping that the fact that we're sitting on a far higher oil price now, clearly it's well above the country's break-even point in terms of their targeted oil price as far as their budget is concerned. But nonetheless, we need some sort of relaxation and some policy change as far as currency management is concerned in Nigeria specifically. So, it's not a majority portion of our business by any stretch of the imagination, but it causes a headache. So that is something that we've had to work with, and we've had quite a bit of success. We declared a very healthy dividend in December to our shareholders, and that was on the back of some success in externalizing Nigerian funds. So, but other than that, the rest of the countries have been sound. We've had no issues. The bulk of our earnings, as I mentioned, are all in dollars. So we're not looking to change that. I think you're on mute, Tayo.
Yeah. Thanks so much, Thomas. Thanks. So I think we've had a very good conversation. Just as we round off, I'm starting off with Nii, moving through to Ilaria, Thomas and then Bronwyn. If you could just do 30 seconds, just to round off, summarize your thoughts, on the continent, just essentially giving a forecast, obviously, from your area of focus on the real estate market. Just 30 seconds, and I will start with me.
Thanks, Tayo. I think for the rest of the year, the view from us is, some cautious optimism in terms of the markets evolving. The level of sort of development activities is still somewhat muted, but you're expecting to see some pickup in that. For us, it's a year of sort of consolidation on key clients, identifying sort of new opportunities and trends that we can follow through. Because our business is primarily sort of real estate finance, it's more sustainable for us to follow through on tenants that on clients rather, that you can follow across the markets, and combine that with some of the larger domestic operators. So that would remain the focus for us. That would remain the area of interest, and the idea is to always provide solutions that help clients solve their current problems, their current challenges, and future challenges, and making the funding solution easier to access, simpler to operate, and give clients the opportunity to focus on their core business towards growth. I think one of the areas that we continue to sort of work across the market is also broadening the access to capital. I think Ilaria sort of alluded to it. So that those domestic capital sources or domestic pension funds, and trying to see how you can get them to, how you can encourage them to participate in the markets, both at the equity and on the debt side as well. And trying to sort of create more sustainability into the nature of the assets you fund and into the funding structures that you provide. That will be sort of my final words for now.
Awesome.
Thanks.
Thank you so much, Niyi. That was a little over 30 seconds. Ilaria, over to you.
I'll do 30 seconds, I promise. I think, I was moderately optimistic. Unfortunately, we don't know how these tragic events in Ukraine would unfold and would affect us. But I think that as far as we are concerned, I think we will keep on staying on our three investing themes, which is social infrastructure. This is housing. I was mentioning this rental platform. So let's see if there are other opportunities to do more of it. And also business infrastructure. And that is, again, logistics, is data center. And I think key, and thirdly, equally importantly, we're looking at climate change strategies. So I was mentioning before, looking at retrofit, and that is a bit broader as a mandate. So we really believe, climate change is one of the key themes, our strategy, CDC strategy in the next 5 years. And therefore, I think we should really spend time in seeing opportunities to have more green buildings and working on with like-minded investors on that and developers. Thanks.
Brilliant. Thank you so much, Ilaria. Very clear, very short and sharp. Thomas.
Yeah, I think in terms of, if we just look at what we're going to be up to for the next 12 months or so, it's going to be very much of the same. We're not going to be looking at reinventing the wheel. It's, it's a strategy that I think has worked well for us over the past 2 years or so that we've endured COVID. So it's going to be prime office, which we overweight. We're predominantly an office player. We will look to add strategic retail where it makes sense. And where we're comfortable with the viability of the assets. Typically we're acquiring these assets in hindsight, so we're able to cherry pick the ones that work. But it's not going to venture too far from that. Industrial is something that we are looking to add as well, and include data centers in that. But that's essentially from an asset perspective where we are. We've spent a lot of time in the past 12 months or so as well in terms of optimizing our balance sheet. So the business is very strong. We're in a very good position as far as growth is concerned. So I think generally very optimistic, and you know, I think as far as building our portfolio, obviously we're planning an IPO in the medium term. It's going to be more of the same.
Brilliant. Thanks so much, Thomas. Thanks for sharing those thoughts. And Bronwyn?
Yeah, thanks, Teo. I think slightly different to Tom. I think we've definitely reinvented ourselves. I think COVID has forced us to relook at our business and our model. So reinvention has definitely been one of our key focus points, and that means infrastructure play. We're very excited about this industrial data center platform we're going to be launching. So watch this space, and we've got some really good money tracking that. Our disinvestment out of retail, for the reasons I've mentioned today, hospitality recovery, a lot of sort of JV partners across Africa, working with the pension fund money. He mentioned that, as I said, we've got over 50% of our investee base, sort of that is pension funds. We've done some strategic deals. We're doing a whole lot more across Africa with co-investment with these particular pension fund players. So ours is actually reinvention and doing things actually a lot better and a lot smarter going forward. And really looking at what types of capital, where do we want to be, and then focusing a lot on our development partners. So we are now taking up a majority stake. So Grit will not just be an income play, but we'll be focusing on development type projects. And we'll have about 20% of our asset base invested in development projects across Africa. So we're really excited around that for the future. And thanks, Teo. Thanks for having us here today.
Brilliant, and thanks for coming on this call. It's been super exciting, actually, moderating this panel and listening to you guys just speaking. And it's very clear that, yeah, like Nee said, we must be cautious, but there is every reason to be optimistic about the African real estate market. Obviously, as leading players in the market, it's clear that you're navigating what may have been seen as murky waters fairly well. You know, talking about liquidity, exchange rate risk, subsectors that ordinarily are not doing too well in other climes, faring much better in the African context, and generally seeing an uptick, you know, in most of the major asset classes, while also there being a lot of pent-up demand and opportunity for what will be classified as some newer subsectors: student housing, healthcare, data centers, and the like. So I would say it looks like happy days, but with a lot of caution and skill required to navigate those markets. Thank you so much to everyone that has joined this call. It's been my delight being the moderator, and looking forward to having such conversations subsequently. Thanks so much, everyone.
Thank you. Thanks for having us.
Yes, Teo.
Yeah. Thanks. Yeah.
Bye. Thanks.
Bye. Yeah.